What is liquidity risk? Have you ever wondered what happens when you want to sell an asset but cannot find a buyer quickly? This situation is known as liquidity risk. It is a financial risk that arises when an entity, like a company or an investor, struggles to convert assets into cash or secure enough funds to meet short-term obligations. This risk is especially important in stock trading and options, where being able to buy or sell assets quickly at a fair price is vital. Let's break down some basic concepts. First, liquidity refers to how easily an asset can be bought or sold without impacting its price. When a market has high liquidity, there are many buyers and sellers actively trading. This allows for quick transactions. On the other hand, low liquidity means fewer transactions, making it harder to enter or exit positions without affecting the price. There are two main types of liquidity risk. The first is market liquidity risk. This risk occurs when an investor cannot sell an asset within a reasonable time at a fair price. This situation is often linked to price volatility and is more common in illiquid markets, where prices can change dramatically. The second type is funding liquidity risk. This refers to the risk that an entity cannot secure enough funds to meet its financial obligations. This can force the sale of assets at lower prices, worsening financial troubles. In the context of stock trading and options, liquidity risk is particularly relevant for traders who need to adjust their positions quickly. For instance, in swing trading, which involves holding positions for a short period, liquidity is key for entering and exiting trades efficiently. A highly liquid market allows traders to execute orders closer to the market's true value, reducing the risk of significant price movements against them. Managing liquidity risk is essential for traders and companies. One way to manage this risk is to maintain a portfolio of liquid assets. Holding assets that can be easily converted into cash ensures that short-term obligations can be met. Another strategy is to diversify funding sources. By relying on multiple funding sources, entities can reduce dependence on any single source, lowering the risk of funding liquidity issues. Additionally, monitoring cash flow regularly helps anticipate and prepare for potential liquidity challenges. In stock trading and options, understanding liquidity risk is vital for making informed decisions and managing financial challenges. By recognizing the importance of liquidity and implementing strategies to manage associated risks, traders can navigate the markets more effectively and protect their investments.